today's video, we'll take a look at the Heiken Ashi trading strategy, and I'll show you how you can apply this strategy and configure it to your preference. Before we continue, let's see how Heiken Ashi charts show prices and how traders use this type of charts when analyzing the price of an asset. Traditional Japanese candlestick charts often change their color, which can make it difficult to read. On the other hand, candles on the Heiken Ashi chart show more consecutive colored candles, making it easier for traders to identify the best price movements. The difference between the traditional candlestick charts and the Heiken Ashi chart. The open of the Heiken Ashi candle is right in the middle of the body of the previous candle. The close of the candle is calculated by the average of the open high-low and close of the current candle. Here is how the Heiken Ashi chart differs from the candlestick chart. The left chart is using traditional candlestick bars, and the right chart it's using Heiken Ashi bars. In this chart, here we can see that the stock is in a downtrend. Now on the candlestick chart, we see that even in a strong downtrend like this, there are 5 to 6 green candles. These green candles tend to confuse us. It will become very difficult to see the trend in real time. On the other hand, if we look at the Heiken Ashi chart, we can see that the candles stay red for the whole downtrend. This shows a continuity of the trend. The trend can be clearly spotted, and the chart is a lot more cleaner. Now, let's take a look at the different types of Heiken Ashi candles and their meanings. In an uptrend, we see green candles with very less or no wicks on the downside. This indicates that the trend is upward, and there are practically no sellers in the market. These candles represent strength in an uptrend. When the uptrend weakens, the green candles start to have lower wicks. This indicates that sellers are entering the market. One thing to note here is that the real bodies of the candle also become smaller, which also shows that the uptrend is becoming weaker. Similarly, in a downtrend, we see red candles with very minimal or no upper wicks. These candles show that there are large amounts of sellers in the market. When the downtrend weakens, the red candle starts to have upper wicks. This indicates that buyers are entering the market. In the same way, the bodies of the candle also become smaller, which also shows that downtrend is becoming weaker. Why use Heiken Ashi bars? Now you know what the Heiken Ashi bar is. The question you may be asking right now is, why use the Heiken Ashi bar for our trades? And the answer is that it simplifies the decision to enter and exit trades. And now, how to enter into a trade using Heiken Ashi bars? Well, it may be tempting to take a long position every time you see a bullish Heiken Ashi bar, or take a short position every time you see a bearish Heiken Ashi bar. Please resist the urge to do this. To have an edge in trading the market, you must meet certain criteria before you can start trading. Criteria for long position. First criteria. The higher time frame must be in an uptrend, which means that the high time frame must make higher highs and higher lows. If you're trading on the hourly chart, then the higher time frame would be the 4-hour chart. And if you're trading on the 4-hour chart, then the higher time frame would be the daily chart. Second criteria. The 10 exponential moving average is above the 30 exponential moving average. Now, the time frame you're trading on must have both criteria 1 and 2. Once there are these two criteria in place, I will look to go long when the price bounces off either of the exponential moving averages, and the first bullish Heiken Ashi is formed at a higher low like this, then place stop loss below the low of the current swing low. Criteria for a short trade. Now that we know the criteria for a long trade, the criteria to get into a short trade is just simply the opposite. First criteria. The higher time frame must be in a downtrend, which means that the high time frame must make lower highs and lower lows. Second criteria. The 10 exponential moving average is below the 30 exponential moving average. It is very simple, and it should not be difficult for you to figure it out on your chart. Now, once there are these two criteria in place, I will look to go short when price bounces off either of the exponential moving averages, and the first bearish Heiken Ashi is formed at a lower high. As for the exit, since this is a trend game, we only want to exit when the price has formed the opposite Heiken Ashi bar. So for long trades, we only want to exit when a bearish Heiken Ashi bar is formed, and for short trades we only want to exit when a bullish Heiken Ashi bar is formed. Trading examples. Here's a trade example of how to get into a long trade. In this chart, you can see on the left that the price has started to consolidate. Consolidation in an uptrend is a good sign, as it could mean that the price could move higher, and the market bounces off the 10th exponential moving average, and forms the first bullish Heiken Ashi bar. Open a long position at the close of the bar. Price did go up further, before an indecision Heiken Ashi bar is formed. After the first indecision Heiken Ashi bar is formed, the next bar after that is a bearish Heiken Ashi bar. That's the signal to exit out of the trade. How to enter and exit into a short trade. In this chart, you can see that the market formed a lower high and bounced off the 30 exponential moving average. Once you see that happen, the next step is to wait for a bearish Heiken Ashi bar to form. When it's formed, go short at the close of the bar. From there the market dropped pretty quickly, and indecision Heiken Ashi bars started to form. Price did go down further, before an indecision Heiken Ashi bars is formed. After the first indecision Heiken Ashi bar is formed, the next bar after that is a bullish Heiken Ashi bar. That means to get out of the trade at the close of the bar. However, not all trades will be like this. It doesn't matter if you don't catch all the trend movements. It's impossible to do so. What you can only do is take whatever you can based on your trading system, and in the long run, that will lead you to profitability.